All right, welcome back to Yahoo Finance Live on this Thursday morning. Tech stocks remain under pressure. Treasury yields continue to back up in the wake of those comments from Fed Chair Jay Powell yesterday afternoon. Joining us now to talk more about the Fed and the outlook for the U.S. economy is Michelle Meyer. She is the chief U.S. economist over at Bank of America. Michelle, great to talk with you this morning. Let's start with something you guys flagged in your note after Powell's comments, that the Fed is going to be reactive to data as it comes in, not preemptive. How big of a change is that from past Fed regimes, and how different might that look in the coming years?
Well, it's very consistent with the Fed's idea of flexible average inflation targeting. In order to achieve a higher inflation trajectory, in order to get to the economy to the point where inflation expectations are rising, where wage growth has picked up, you need an economy that really runs very hot, which means that you don't want monetary policy to tighten before it's time to tighten, which means it's hard to be proactive, right? To give a lot of forward guidance in advance about upcoming policy changes based off of forecasted outcomes could prompt the economy and the markets to tighten too early. So that's what the Fed is trying to do. That's what Powell's trying to say is, look, we're going to wait until we have evidence. We're going to move on actual data. We're not going to move on forecasted outcomes so that the monetary policy response is appropriate in the current time versus in advance.
Michelle, it's great to see you. I think we have to talk about inflation inputs a little bit more. We sort of don't tease out the components that often. We got another read of inflation today. The Philadelphia Fed prices paid, part of that index was hot, much higher than expected. But most of what we've seen so far is not labor inflation, right? It's stuff. Do we need to see that the labor inflation start to pick up before? Is that a key component for the Fed to be watching? Is that something, for example, that doesn't tend to be as transitory?
Well, Julie, I think you're spot on. The sources of inflation are critical. So we know that there are, goods. We've seen goods inflation. We're seeing producer price inflations. We're seeing certain types of costs increase, whether it's commodity prices or for builders, it's lumber costs. That's all very clear, and we can track that in real time. But what matters for the economy, particularly when you think about the Fed's reaction function, is they want to see consumer price inflation, and they want to see signs that consumer price inflation is persistent, which means that people need to be getting paid more in order to justify higher prices. And you need to see that positive feedback where wages are rising, and as a result, people are able and willing to pay more, businesses are doing better, they can pay people more wages, and you get this positive feedback loop. And that's one of the reasons that Powell is so focused on transient versus sustained inflation. We will see and are already seeing these transient inflation moves, and they're potentially, going to be aggressive. There will be bursts of inflation. Some of that will be passed on, but it will only be able to be passed on a persistent basis if you have higher labor as well.
Michelle, what's the impact to U.S. consumers here? The way I'm thinking about it is we're going to get this inflation, maybe transitory, but there's going to be inflation. But I can't imagine the wage recovery is going to be strong out of the gate here.
It's interesting when you look at wages in this cycle versus the last cycle. They've been a lot more resilient. Coming out of the great financial crisis, it was a slow, painful recovery. It was one of fits and starts. And in a sense, we had these almost mini recessions throughout the last decade as the economy was more broadly in an expansion. And as a result of that, we had a decent amount of downward pressure on wages. We never had a wage reduction on aggregate, but it was a long time before wages start to show any sign of turning higher. This scenario is very different. It's a much faster recovery. You don't have as much detachment from the labor force. And for those people who have kept their jobs, the wage trajectory has actually been pretty consistent. So we'll see. I am more hopeful, especially relative to last time, that we will be able to see a faster trajectory for wages. But of course, you need to return to full employment before that shows up in a broad-based manner.
So, Michelle, to bring it back to the Fed and also the interplay between markets and the Fed, you're talking in your note, you're not looking until 2023 for the zero lower bound to start to move higher. The market doesn't seem to think that, right? So there does seem to be this disconnect here. What do you think is that disconnect? What's the source of that?
Yeah, and if you listen to Powell yesterday, it's even beyond 2023. It's not in the forecast horizon, that first hike. So what's the disconnect? So I think if there's a few things. Part of this goes back to what we talked about initially, which is being reactive and not proactive. In that the Fed doesn't want to signal that hikes are coming based off of forecasted outcomes. They're going to wait to guide to that once they actually see the stronger data. And that does mean we might see a more kind of dramatic repricing once the Fed confirms or argues against what the market has been pricing in. But at the moment, the Fed isn't going to address specifically market pricing because it is so far into the future and the crystal ball is foggy. And as Powell said, the likelihood is that a lot of things will be different relative to what is put down on paper today and what we actually end up seeing in 2023. So everybody's putting their best guess in, both in terms of how the data will evolve, but also what the Fed's reaction function will be. And markets are getting a little bit, kind of itchy in a sense to test the Fed's resolve around sitting at the zero low bound despite, extremely strong economic performance.
Michelle, where are you at in terms of first half GDP growth? This week, we've gotten disappointing retail sales, housing starts. I think a lot of investors, they just want to see this data starting to improve. I
would ignore the February data. It's highly weather distorted. I mean, think about housing starts were weak, but of course it was in the areas where you have a deep winter blizzard. The retail sales numbers, I would also look past the weakness in February. Not only because of weather, but because we also had a delay in tax refunds and there was also a stimulus reversal. So I really wouldn't worry about the February data by any means. And I think as we look into March, we're going to have pretty exceptional numbers on the economy. And frankly, a lot of the survey data and the more high frequency data is already revealing that. Look at the Philadelphia Fed index today at a 50-year high. So that does suggest we're going to continue to see further business investment and a pickup in economic performance.
All right, Michelle Meyer, Chief U.S. Economist at Bank of America. Michelle, really appreciate you jumping on with us this morning. Hope we'll stay in touch.
Absolutely. Thank you. Have a great day.